is Invisible Inc., the podcast for under-resourced women entrepreneurs. And I'm your host, Shubha Chakrabarti, founder of Achieve. Join me as I talk to women entrepreneurs about the nuts and bolts of their journeys and to experts who will give you insights that are hard to find anywhere else. Let's jump in. What does a cutting-edge cybersecurity company have in common with the medieval Dutch church? What's the most critical ingredient for any company to fulfill a meaningful social purpose? What important aspect of the venture capital model do most founders fail to understand? In this episode, Dr. Melanie Rieback, CEO and co-founder of Radically Open Security and startup incubator nonprofit ventures, talks about the inspiration behind the unique organizational structure for her startup, implications of VC funding that few founders realize, attractive alternatives to VC funding, and much more. Now, here's Melanie. Hello, Melanie. Welcome to Invisible Inc. We're so excited to have you here.
Thank you so much for inviting me.
So you have a very interesting background and you are pursuing a very different business model for your own startup. So can you tell us a little bit about your startup and what's different about how you have designed it?
Sure. I'm running a cybersecurity company that is roughly 9 years old. We have about 50 staff members. We've had hundreds of customers, everything from Google to the European Commission to the Dutch energy grid to nonprofits, NGOs, and civil society. So really what my company, Radically Open Security, is we're a social enterprise in the cybersecurity space. And we give all of our profits basically to charity. So we're registered with a really funny business model that's called a fiscal fundraising institution, FFI. And that's a really archaic construction from the Dutch church. So sometimes a church wants to have some kind of commercial spinoff, then they bake some brownies and whatever. Basically, the profits from that to go with a tax benefit back to the church. We basically took that tax construction and we made our so-called commercial spinoff, a cybersecurity company, and our church, the NLNet Foundation. And NLNet is a funding agency that's been around for about 30 years, and they donate money to open source projects, digital rights initiatives, and anything for a better open internet. So anyone here who's a techie, who's heard of some usual suspects like Tor, GNU, Jitsi, DNSSEC, WireGuard, those kinds of projects basically are the beneficiaries of that money. And in the first, I think, 7 book years, roughly, we donated approximately €750,000 to the NLNet Foundation. So we're proof that we donate 90% of our profits to NLNet. The last 10% is our cash flow buffer, which is what we need to make payroll at the end of every month. And for the rest, we can reinvest as needed also just for building a solid platform of a business. We also provide cybersecurity services on a nonprofit basis, on a zero margin basis, to nonprofits, NGOs, and civil society organizations. You know, they've literally got the world's scariest attacker model, like a nation state after them, and almost no budget. In that sense, we operate with a bit of a Robin Hood kind of model in that the governments and the corporations basically pay our bills and allow us to keep the lights turned on. And then once that flywheel is spinning, we can then use it to also service the little guys.
First of all, multiple congratulations. Great progress and just a very impressive client list. Love the longevity. I love the economic discipline behind it. What got you interested in how did you come up with this model in the first place?
Yeah, so actually one other thing I didn't mention also, and which is kind of important, is that I also very early on sold the company for €1 to a foundation. In that sense, it's a little bit like Patagonia, actually. But rather than sort of giving away the company at the end after it was worth a whole lot, I kind of built it in that way from the beginning. So what made me decide to go this route? It was because I was not entirely happy with the incumbents in the Dutch cybersecurity market. We had companies that were working with intelligence agencies, that were hacking activists, that were building surveillance boxes and then selling them to developing countries. And then the Dutch hacker community would call them on it and say, hey, that's not a good thing to do. And did they stop? No, they just sold that part of the company. And if it wasn't them, it was like the big accountancy firms, which, I mean, they weren't necessarily sketchy, but they were so commercial that it's kind of worthless. So in that sense, I really decided that we need parties, on the cybersecurity market that really deliver value in the sense of being open and transparent in how they're working and sharing knowledge rather than just putting everything into little proprietary black boxes that can be withdrawn the moment a customer stops paying. Because security is a long-term process and it's a mindset. It's not just a set of patches that you get from a pen test report. So basically, I wanted to build an organization that really optimized for that knowledge transfer. It just so happens also that that's pretty good value for customers because, that really helps them to meaningfully improve their security posture. So between that and the fact that our business model also attracted a number of very talented, idealistic hackers, which also allowed us to serve security services of pretty good quality, that was the formula that really allowed radically open security to take off. And also it didn't hurt that a lot of chief information security officers also of large corporations just so happened to also be idealistic techno hippies that were also part of the hacker community. And they also fought the bureaucracy of their corporations and governments, organizations to get us in the door. And that was, I think, really how radically open security got established and also became as successful as it has been.
So do you think, or do you have examples of the same structure being successful and tried out in other countries? Because it sounds like there's a Dutch artifact in terms of this fiscal foundation infrastructure. What examples have you seen and what would be comparable models or structures that would be available, for example, for entrepreneurs in the United States as a starting point?
Yeah. I think the FFI is a cute talking point, but I don't think it's necessary. I think the real part that's important is to try and build businesses that aren't leaking capital. And I think that that's very well encompassed by the steward ownership movement. Because I think the FFI is nice, but I think what's more important is that we're foundation owned and that we also have some protections in place to prevent the company from being sold. There's an entire global community of companies that are doing this. Oftentimes foundation-owned companies, perhaps that incorporate golden shares or similar constructions to prevent companies from exiting. Because, my hypothesis is that if we can prevent people from becoming unnaturally wealthy from a company, and when I say unnaturally wealthy, I mean anything above like middle-class salaries with a pension. Of course, we need to support our families, right? But it's just more that we don't need millionaires and billionaires. Without that incentive there, the only thing left, like the only reason for being for these companies is social impact in the sense of also providing some kind of a product or service that has enough of a product market fit that people need it and that they value it enough that they're willing to actually pay something for it. And we need products and services to run our societies, whether it's just like the restaurant on the corner or the plumber or just the hairdresser or a software development company. I think every company can be a social enterprise, regardless of whether or not you're focused on the sustainable development goals. Like if you have a governance structure where you are changing the incentives in as such that there is no money leaking out of the company to build a 1%. And that's it. And if the leadership of the company is willing to put such governance structures in place, that's also leadership from the top, and that permeates through the entire company. And it sort of sets the North Star of the company as being impact, which then means that everyone all throughout the organization, if that's their North Star, then every tiny operational decision in day-to-day operations, they're going to try and choose the thing that seems most aligned with the social mission. And in that sense, it's taking a systems thinking approach in that we can try and play whack-a-mole with symptoms, like with the environment and with society. But actually, I believe that it's actually the governance structures that are the root cause. And the environment and society, these externalized costs onto environment and society, these are the symptoms of the problem. So really, if we can reform governance structures, reform the G and ESG, then the E and the S will kind of come along for free. So that's my way of looking at it.
For those of us, our listeners who are not familiar with golden shares, can you just give a very quick overview of what golden shares are?
Yeah, so a golden share is a kind of poison pill construction that prevents a company from being sold. So in other words, I can give you a single share. It's basically a veto, like a blocking a share, which you can basically use to just block the sale of the company. And that's all it does. There's no profit rights that are associated with that share, but it's just to ensure that the company, well, you're trying to raise the bar basically to make it harder for the company to ever get sold.
So let's say I'm an entrepreneur. I'm very inspired. I want to create social impact, which, by the way, it reminded me of what Peter Drucker wrote, I think, 70 years ago, that the first purpose of a business is to create a customer. So that, in my view, is you're existing because you're here to serve a need. So that definitely resonated. So I'm here, I'm inspired, I want to start a business. What are the first steps you would recommend that someone like me would take? And then allied to that, there are some businesses that are capital light, and then there are some businesses that are capital heavy. Can you first talk about how I would take the first steps? And then secondly, also talk about how to address the capital problem if it's a capital intensive business.
Sure. I would say start with yourself. What is it actually that you care about? What is it that's important to you? If you could consider your business to be a form of activism, to change the world in a way that you think it needs to be changed, how would you start a business related to that?
I hear what you're saying. Let me maybe clearly there's a business model that needs to be here. I mean, no matter what your governance structure is, it needs to be economically value creating. It needs to somehow put out into the world a little bit more than it took in. And the little bit more comes from your ingenuity, the fact that you have super smart hackers in your case, and they make the world a better place than it would be without the hackers, right? So there's some economic model that's creating value. How do you make sure that that happens when you're driven by market forces in terms of revenues, pricing, and costs?
My answer doesn't change. Start with why. There's a reason why that TED Talk by Simon Sinek is so popular. If you start with a why, then you can work your way over to the what and the how.
And is there an example, aside from your own business? I know you also run an incubator, and we'll talk about that, where you can talk specifically to the pieces around how they create a monetization model, how they put together a system that basically works on a sustainable basis, just like yours does.
If you want to create a business where you're keeping yourself independent of external capital, then really what you need to do is you need to find launching customers. And this means you have to create MVPs, so minimum viable products, and then you need to collect validated learning by trying to sell it. And then you need to pivot to follow the pain in the market, and you need to iterate many times. And the point is, you need to, with these MVPs, really try and find something that someone will pay for, right? If it turns out that whatever your initial idea was, if it won't sell, because it's one thing like surveying people or just asking people, what do you think about this? And there's a really brilliant book on this topic that's called The Mom Test, which is basically about how do you survey the market in such a way that even your mom won't lie to you, on the premise that basically when you ask people, hey, I've got an idea, what do you think? They're all always going to lie to you, and they're going to be like, yeah, I love it. And then you're like, yeah, great. Are you willing to pay something? And then they're like, no, and that's a perpetual problem that founders have. We just think if we do some kind of survey that somehow we're going to get valuable feedback, but it couldn't be further from the truth. We collect what people think that we want to hear, or because they're trying to be supportive or be good friends to us, but it doesn't actually tell us anything at all about what people are willing to pay for. So really what we need to do is we need to try selling something, but that's uncomfortable, right? Because at the moment that you have to ask for money, but this is where the rubber meets the road, right? I mean, if you're a business, you should be selling something. Otherwise, you just have a hobby, or maybe you're trying to run a nonprofit or something, but a nonprofit isn't a business. So really the essence, if you're trying to build a business, is just to run these experiments and try and sell something. This is the opposite of the kind of VC and hypergrowth approach that's the entire rest of the market is pushing you to follow. That's the opposite of the lean startup, because if you get a huge amount of external capital that you're supposed to put into some kind of R&D, the problem is that because you are not actually trying to sell something, you wind up creating a product market disconnect. And this is a particularly pernicious problem with techies, particularly ones who are in love with technology. And I'm a former assistant professor of computer science, so I know this firsthand, and I also have a first failed startup that died exactly with this. What you wind up building is like beautiful technology that is exactly what you envisioned. You want to make it beautiful and complete, and you build these technology cathedrals. And then when the money is almost ran out, then you ask yourself the question, okay, gee, I wonder if someone wants to buy this. Yeah, by that time, it's too late. And then it just turns out that whatever it was that you were building for yourself, it turns out that it wasn't what the market wanted. But by that time, it's very difficult to pivot. It's not to say that you can't pivot at that point. You can, but the problem is the sunk cost fallacy. Because at that moment, you have so much legacy baggage that you put so much time and money and energy into that you're very reluctant to throw that away and start over. And that's actually, ironically enough, why it's actually easier to bootstrap a company without capital. And a lot of people call VC an accelerator, but then the question really is just like, what are you accelerating? Because also, even if you can build something, and even if there are some users that have some kind of uptake of whatever you're building, your business model still isn't going to work out because the unit economics won't make sense. And the reason why they don't make sense is because you're hiring people too quickly. People are the number one expense of most companies. Like, people are expensive. This kind of hyper growth where you get this external capital and you're just hiring people as quickly as possible to externally look successful. I mean, this is all optics. But if you then actually check the balance sheet, most of these companies are terribly in the red. And the thing is, they're not actually trying in that sense to be whatever company it is that they're positioning themselves as. Let's say you're a small cybersecurity company, right? And you've received some amount of venture capital. The business model with this is not selling cybersecurity services and products. The real business model of such a company is equity, because the moment that they're working towards is getting acquired most of the time. Or if not that, then going public in an IPO on the stock market, which again is a liquidity event. You're making your money off of equity. And that's a very, very different business model than selling products and services. But the problem, though, is then what you've got is a whole bunch of small startups that either they're successful in this hypergrowth approach, which 1 out of 10 maybe are, because remember the statistic, 90% of startups fail, right? So the majority of them, they're just going to run out of money if they're not successful in continuing to play this VC game to get these increasingly large rounds so they can reach the liquidity event. So 9 out of 10 startups fail. And then the 1 out of 10 basically that succeeds, I mean, they're attempting to become a unicorn. And a unicorn is a company with a $1 billion valuation or higher. And we look at these things like they're these great success stories. Like, we want to build a unicorn, or maybe even better, let's make a decacorn. Great. And if I want to be super successful, then I do it multiple times. And then I'm a serial entrepreneur, right? And then after that, I become a VC. That's like the next step. But the point is this really what we need? Because here's the thing. First of all, with our IPOs. So, okay, you've got this thing that is bleeding money terribly because of this hypergrowth approach. What you're basically doing is you're hyping it up and you're pumping up this cash-losing thing. And what you're essentially doing is you're performing a kind of pump and dump scheme onto the public markets. Because if it's cash losing before the IPO, it's probably still going to be cash losing after the IPO. But people don't care. They buy the shares during the IPO because they're speculating, right? And they're betting on something called the greater fool theory, which basically means it doesn't matter actually what I buy, as long as there's a greater fool who is going to come after me, who's willing to pay more. And you could do this for shares on the stock market or IPOs or cryptocurrency and NFTs or tulips. I mean, take your pick, right? And this works in a growth economy. But the moment that the economy starts to stagnate, or that for example, the Fed decides to raise interest rates, and then we find ourselves in a recession kind of situation, which we happen to be in at the moment, then of course, everything tanks. Because the unit economics never actually made sense to begin with, and they still don't make sense now. And that's when we have these really big corrections, which wind up causing all kinds of people to get laid off, all the asset owners now. Part about this, although that's really tricky, is with these cash-losing unicorns, like WeWork, for example. I mean, I think they were spending money, I think it was 5 times faster than they were getting it from customers or something like that. And we don't ask the question often enough, whose money are they spending? And it turns out that 65% of the investors in US-based VC funds are pension funds. which basically means, whose money are they spending? Well, ours, for when we want to retire. But most people don't think it through to this extent. And you would ask the question, okay, but why are pension funds investing in VC? And quite simply, up until recently, the answer had been low interest rates. Because basically the kinds of safe investments like bonds and, negative interest on bank accounts, they were moving over to so-called riskier asset classes like VC because they were promising much larger returns, like, hey, we'll get you 10x, 20x, whatever. But truthfully speaking, though, historically speaking, VC has not had those kinds of returns. And if you historically also look at the performance of the stock market over the last 25 years and then compare that to the performance of VC funds, 85% of VC funds have failed to keep pace with the stock market. So most of them, if they're saying like 10x returns, no offense, they're full of it. Because, statistically speaking, that isn't what has been happening. So if you had literally bought an index fund and held it, you would have done better than 85% of VCs. But the thing is, we don't know this, and we can't even evaluate VCs correctly anyhow until probably at least 10 years after the creation of their fund. And by that time, they've already received their 2% management fees and then cashed out. And now that they're on some island somewhere in the Caribbean, at that point, it's too late. But the problem here is that we've created this system where 9 out of every 10 founders are failing, which I would say is pretty bad. The pension funds are losing money. So basically, they're losing money after the IPO if they buy the stocks and then it tanks. They're losing money before the IPO because basically the VCs aren't giving the returns to the LPs that they're promising. And then you need to ask the question, okay, but who's winning here? Who's winning in this system? It turns out that actually the only people that are winning are the fund managers, the very, very lucky founders that held an equity position and maybe some of their service providers, but that's it. But the problem, though, is that those who have the most money have the loudest voice because they've got the largest marketing budget. They are the ones that are setting up our startup ecosystem in the current form that it is now, in the form that when founders get there, we are told that we need to follow the Silicon Valley model of capital, scale, exit. But what we're not doing is we're not asking the really important questions of, is this capital scale exit model, is this actually getting us where we need to go as a society? Is this treating our planet in a responsible way? I think most of us can see the problems, right? We sort of vaguely know that the system is responsible for it. But then if you ask people, well, what is the system? Then they're just like, nobody knows, right? And very few people can actually tell you how the financial system works. But the moment that you start digging and you start following, it's follow the money, but it's true. And you start understanding the incentive structures. And it's like Charlie Munger says, show me the incentives, I'll show you the outcome. So what we need to do is we need to really take a systems thinking approach in the sense of just understanding that rather than playing whack-a-mole with these symptoms, we need to realign the incentives because that will cause the larger emergent organic behavior of that system. Because as long as we are financially incentivizing people to externalize costs onto environment and society, they will continue to do so.
Got it. And that was it was a very masterful exposition of how the financial system works and what the first order and second order consequences are on entrepreneurs. So thank you for that. That is very articulate and cogent. So that brings us back to what is the micro level action that an entrepreneur can take. And I want to focus on one thing, which is you talked about the very large hyper growth certainly resonates, right? Understand that, see that in the newspapers every day. And then you have the micro, very capital light model where maybe you don't have to invest a lot. Certainly, I take your point about not needing to hire to super fast, but there is a case in the middle where capital is needed to be able to build a functioning business, not decacorn or unicorn. What models work in your experience and in your mind to fund where there is a delay between the time you start putting in the work and the time you start generating revenues and cash on a sustainable basis? What are the funding options and how should a post-growth entrepreneur be thinking about that funding requirement?
Right. So there are indeed these cases in the middle. And if I talk about bootstrapping, the first question I always get is, yeah, but there's some stuff you can't bootstrap. Like, what about a power plant? You can't bootstrap a power plant.
Someone asked you about the power plant.
Yeah, and it's true. You can't bootstrap a power plant. But I think in the case of a power plant, it's probably government funded. So, and that's also a special case. But here's the thing. There's this really wonderful economist whose name is Mariana Mazzucato. And she's an economist from University College London, and she's written many books, one of which includes a book called The Entrepreneurial State. Her thesis in the book is basically that the government is the world's largest VC, but we're socializing the costs and we're privatizing the benefits. In the case of our power plant, what actually is happening here is that the energy company that's running this power plant probably falls into the category of a business that I would call a quango, a quasi-NGO, right? And actually its main purpose is to serve a social need. We need power, or perhaps we need clean water, or perhaps we need roads or other kinds of infrastructure. And frequently, anyhow, the main shareholders of such quangos happens to be the government. But in this particular case, the problem, again, socializing the costs, privatizing the benefits, we need to ask ourselves the question of, okay, but how is that happening? And let's take a really frequent case of government investment, academic research, fundamental research. We can take something like, for example, vaccine research. And I can give you a good example. There was a company, basically an academic researcher who was at the University of Leiden in the Netherlands. And they wanted to valorize their research that was probably funded by the Dutch Science Foundation or the European Commission or one of these. So what happens if you're an academic and you want to valorize something? Well, you're probably going to go to the technology transfer office at your university. So the TTO officer at that point, most likely, the first thing they're going to do is they're going to try to patent anything that moves. Which is a bit odd if you think that we're putting a barrier to entry in front of using stuff that was publicly funded, but all right. And then the second thing that they try to do is they will probably push you through to the academic incubator that's affiliated with the university. Now, the academic incubator most of the time will then say, hey, I happen to know some venture capitalists that I can introduce you to, and we can get some additional investment so we can turn this thing into a company. Now, there's a problem with this. The problem is that the venture capitalist is coming in at a relatively late stage of the game. And they are also for a pretty small investment compared to the huge initial investment that the government made. They're getting a significant percentage of both the profit rights and the voting rights for that startup. So that leads to the kind of situation where you have governance issues for the company. And coming back to this example of this researcher in Leiden, they did exactly this. And then their company got VC funded, grew exponentially, and then they were acquired by some party from the United States. And then at a certain point, the pandemic happens. And then we need, of course, the facilities of this company in order to produce vaccines. Only one problem. The American owners of this company based in Leiden forced the company to serve the US market before the Dutch market. And that's sort of the moment where the government actually needs to start asking themselves the question of, well, what are we doing here? If we're creating this investment in these kinds of local companies, why are we considering it actually a good outcome for this to be sold? And this happens again and again and again. Like in cybersecurity, there's also another example of one of the market leaders in the Dutch cybersecurity space, originally bootstrapped, but eventually wanted to go the hyper growth route. So they teamed up with some VCs. At a certain point, it was like, congratulations to this company. They've just been acquired by a different British cybersecurity company. And then the problem was that the monitoring boxes that the security company had made were all throughout the Dutch government, defense, big business, intelligence even, and the entire customer base collectively let out an, oh shit, our data's going to the British. So what happened next was they started jumping ship, and there was another spin-off, a smaller startup that had spun off from the same company. And some of these customers switched over to this startup that was making similar monitoring boxes because, hey, at least this is still like a good Dutch startup, right? Same story. Then they also got VC funding and then they grew exponentially. And then 2 years later, I read the press release. Congratulations to this other company. They've just been acquired by the Romanians. At a certain point, it's like, okay, like, are we ever going to learn here? And it turns out actually that, yes, we do learn because the Dutch government at that point started requiring a golden share to be held by the Dutch government for any critical cybersecurity company that was basically dealing with the government or with critical infrastructure. So they did learn. And they don't call it this, but it turns out that that's actually kind of steward ownership. That was the solution to their problem. So coming back then to these government projects, the government doesn't want to bootstrap things. They just want the problem to be solved. Like if you're a government, you want a vaccine, you want a school, you want a road, you want a bridge. You don't want to have to like deal with the whole process of like, how do I get there? You just want to give it to a company or an investment fund and let them work on it further and then just be done with it. But what we don't want is cash leaking in every direction in the process of building that government project, which oftentimes happens with the contractors. And then you get scandals and things are over cost and things are out over the deadline. But this is actually where building what I would call a non-extractive company can help. Because if you, at that point, give the assignment to a foundation-owned, steward-owned company in which you ensure that basically all of the cash is getting fully reinvested into the business beyond middle-class salaries and a pension, and also you're preventing any kind of liquidity event, any kind of exit, that company being sold, then what you're doing is you're creating asset locks. You're creating a company where you actually can't pull that financial value out of the company, which means that the only purpose left that that company has is to provide that product or service in the most socially responsible and environmentally responsible way. And then they'll do that for you. So for the company, it makes total sense actually to embrace the concepts of non-extractive business for these kinds of government subsidized projects. And the same concept also extends to investment funds as well. You can also create non-extractive investment funds that also use steward ownership, foundation ownership, and also reformed fee structures that similarly also can prevent cash from leaking out of this whole thing to really ensure if you are going to be running this fund, that it really is focused on what it's supposed to be focused on, which is realizing this product or service or groups of companies providing these products or services that are something that the government and society really needs.
And I like how you differentiated the big power plant-like investments, which clearly you need a huge player like the government, right? Whether it's clean tech or whatever the case might be. And then there are also the other companies, which are, let's say, ABC company down the street that does need scale, that does need capital, but doesn't have as tight a nexus between some state infrastructure goal, for example, and funding, and yet needs capital. What I'm hearing you say is that capital is just a force. You just need a resource to make it happen, but it's different from the governance structure, which is really your focus. You can say you can have the same amount of capital, a different governance mechanism than you do today in the kind of the VC standard model is kind of the first point I took away. So then coming back to our entrepreneur who wants to start this company, now she has a necessity to get funded. She's not clean tech. She's not something that's state sponsored or state funded. What options does she have from a capital acquisition perspective to go and fund whatever she needs to fund to meet her objectives?
So for that entrepreneur in the middle that can't bootstrap, but also isn't a power plant, look, there's two approaches that you can take. If you're smaller and don't mind organic growth, then I think the best approach is just to start a service company and then use margin off of the sale of these services to fund the research and development on product. It's a really good model. I mean, also Radically Open Security, my own company, has used that model. We have a thriving services business with a high margin. And we use the cash from that to fund my other projects, some of which are activistic in nature and some of which are things like building IT infrastructure, software development. And the nice thing is I can open source all that software that I develop and give it away for free because there was no VC who can tell me not to. That's also kind of nice. And also, by not putting up a barrier to entry to the stuff that we're creating, that also generates a lot of reciprocity, which is good biz stuff, which sells more services. So, I mean, it creates a virtuous cycle. It's not as slow as people think, by the way, also, because there are occasionally contests like a fastest growing company and things like that. But I did notice one time that a VC funded company probably did grow roughly around the same speed as my company did. But just the big difference is, we've been profitable from day one, whereas this other company, they were also successful. They got acquired in the end. So, I mean, if that's your definition of success, they also met that goal. But it's just a different model. But for the ones who don't want to take that kind of lateral thinking approach where you're using a service to cross-subsidize product development, I think another approach is you would need to have, and I mentioned this before, kind of a non-extractive investment fund. And this really requires brave financial professionals to create a market that right now actually barely exists. I can give you, though, one example that I think is quite nice, and it's called snowball impact management. So the CEO, her name is Daniela Barone Suarez, she wanted to create, in this case, it's a VC fund of funds, but she wanted, first of all, just to make things really that are different and optimally social. The first thing that she did is it's foundation owned. That's already different than most investment funds. The other thing that she did after that is she reformed the fee structure. Let me just make a small segue on fee structures. So the typical structure that most financial professionals, including VCs, tend to use is something called 220. 2% asset under management fee, and a 20% what's called carried interest. So if I'm a VC, then what that means is with the 20% carry, if one of my portfolio companies grows exponentially, with that hockey stick, and then they exit, I get 20% of that. Now that's a super powerful motivator for me to push my portfolio companies to grow exponentially and then exit, right? So you can even say that 20% carry embeds the growth imperative into startups. If you want a VC that will willingly cultivate companies for the long term that are allowed to grow organically and that aren't just expected to exit in 3 to 5 years, just take that 20% from their compensation package and toss it. Just get rid of it. Because again, you change the incentives, you get different outcomes. The 2% is also the management fee. So if I'm a pension fund and I give money to this fund manager, I pay them 2% just for managing my money with the hope of getting returns. If the fund is small, 2% is not that bad. But if as that fund grows, this 2% can become extremely extractive. For example, like let's say that I want to retire someday. So I have a Roth IRA or a 401k or one of these kinds of investment vehicles. And let's say that I have a fund manager with a 2% management fee for that fund. Given the historical performance of the stock market over the last 25 years, with a 2% management fee, I will have given 2/3 of my returns to the fund manager.
Even before the 20% carry.
Yes. So most people don't realize how extractive this is, but John Bogle, who is a very famous...
My hero.
Yeah. So for those who don't know who he is, he was the founder of Vanguard, which is basically one of the big 3 investment firms. He used to talk all the time about the tyranny of the fees and about the conflict of interest between the fund manager and the investors. And by investors, he meant people like you and me, pensioners and retail investors. And really the reason why John Bogle, he invented the index fund, and the index fund is just passively tracking the entire stock market. The reason why he created this was because he wanted to drive fees down to zero by basically passively tracking the stock market via an index, as opposed to active portfolio management, which requires humans who then pull fees out of this. And he was largely successful with this, with the index funds, because now if you want an index fund, what are you paying? Probably like 4 or 5 basis points. I think Prudential has like literally a 0% index fund. It's a loss leader for their other services, but it really shows, John Bogle was trying to create a not-for-profit investment fund. The whole concept sounds crazy, but it actually has a really storied legacy. And they called it Bogle's Folly, the index fund, when he first invented it. And of course, that also grew out into an entire, because of course, a superset of index funds is just ETFs, electronically traded funds, which is now, and passive investment is now, I believe, 35% of the total investment globally. So yeah, folly indeed, right? But the point is, though, with this kind of mutualized mutual fund that Bogle was attempting to create, if you talk now about creating investment funds that are not for profit, that idea is not so crazy. And I'm coming back to, with Snowball and what Daniela Baroni Suarez is attempting to do with that. She took that fee structure, that 220, and she took the 20% carried interest and she got rid of it. And then she took the 2% management fee and she changed it into cost of doing business, assuming middle-class salaries and a pension. That's it. And the whole thing is foundation. Oh, and so she too was creating a not-for-profit investment fund. And she is a pioneer, but she is not the only one. There's another example also of an ETF that's called Impact Shares, that's based out in the United States. And it was started by the NAACP, the National, I think, American Association for Colored People. And they're an NGO who wanted a sustainable funding source, really. So they created this ETF and they housed it basically as a 501c3. And then the point is that they had all of their profits and returns above and beyond what they needed to run the business are then reinvested back into the fund itself. But of course, because it is an index fund, it's giving the returns that a typical index fund would have. And what it's then doing with the rest of those returns is it's donating them to the NAACP.
Very similar to your model, right?
Very similar to my model and to Patagonia's. So the thing is, there are ways that we can create non-extractive investment funds or even investment funds that are cross-subsidizing charity, not with 10% of their profits or 5% of their profits, but with literally like 100% of the non-reinvested profits. And the thing is that any investment professional could do this. Like there's nothing unique or special about the people who started Impact Shares or even, Danielle is great, don't get me wrong, but like anyone can do this. And she encourages anyone to do this. And coming back to this Mariana Mazzucato problem, right? Like, let's say that I'm the government and I want to have some small or some SMEs that are dedicated to tech, to something medical, to food, to whatever, right? Then what I could do is I could create basically a VC fund that runs in exactly this fashion with a reformed fee structure and with reformed governance with things like steward ownership and foundation ownership, thus ensuring that the fund manager will only ever be middle class. And then you're going to ask the question, yeah, but what fund manager is going to want to do that?
Well, I was just going to say that the removing the 20% definitely changes behavior, but it'll also change the pool of people who want to become VCs. I'm not saying that's good or bad, but that does have ripple effects where you need to figure out, okay, what does it do? Just like Bogle's Vanguard changed the class of fund managers and created a whole new class of non-managers, right? Meaning you don't need to be sitting there watching what's happening. But that's a different story. But please go ahead. Yes, that is the question.
Yeah, but it might cultivate a different crop of fund managers. But is that necessarily a bad thing? Yeah, because a lot of people who go to business school and who want to study finance or other business topics, oftentimes they are there because of money, because they want to be able to earn big upon their graduation. Well, it could very well be that there's some mid-career professionals who are sick of everything and been there and done that, and they're in their 40s or 50s, they realize the clock is ticking and there's not a whole lot of time left. And time is the limited quantity, not money. Some of these people might actually be willing to be that pioneer, to be that change in the world, to leave their legacy, because that money, you can't take it with you, right? But they can use their experience and their expertise and their experience in whatever fields that they happen to have been working in and apply that. And they probably can make perfectly good fund managers, and they're there for a different reason. See, we assume that good fund managers are greedy. What if it just so happens actually that the best fund managers might be the ones that aren't doing it for the money? Maybe there are some people out there that are just willing to do it and to be middle class, but the pool of people that you need to get, you might need to get them from somewhere else. Because the problem is that these kinds of excessive fees are so normalized in the financial industry now that, of course, those who are already receiving them are probably not too likely to want to make that kind of switch, with exceptions. I mean, look, Daniela Baroni-Swire, she also used to be a more traditional fund manager before she decided to go this way with Snowball. It could even be with you. I mean, that maybe you've been there, done that, been in banking, gotten burned out, need to try something else. You're also the kind of person that very easily could start a fund like this. But it's just a matter of desire and making that entrepreneurial decision to do things differently. I mean, me too, like with Radically Open Security, like nobody twisted my arm to make me sell my company for €1 to a foundation. I knew full well what I was sacrificing when I did that. And I'm not blind to the fact. I read the same industry trade press and publications, and congratulations to this company that just sold for tens of millions. I know what I gave up by doing this, but I also know what I gained. And what I gained is the knowledge that I created a really unique organization that is creating a huge impact through cybersecurity. Anyone can do this. And you would then think, but what founders would want to make that sacrifice? Turns out a lot of them. I also created Nonprofit Ventures, which is a startup incubator for non-extractive startups. So basically, anyone who's interested in of charity kinds of models. So far, in the first 3 cohorts, I've had roughly 50 startups who wanted to be incubated this way. And also, we just opened also a combined train the trainers and incubator program also for 2023 that I just opened roughly like a month ago. I'll tell you, like I posted on LinkedIn for the train the trainers, for example, and within 3.5 weeks, we had 130 applicants.
That's great.
It's crazy. And also for the incubator, I think I'm busy with interviews right now with the folks that applied, but we also have, I think, roughly 25 applicants this time. I mean, usually I narrow it down, not to have smaller cohorts just to keep things personal. But I mean, I've got more people applying, almost than I can handle. And that's just from one post on LinkedIn to people in my network. And that's the whole reason also why I'm doing the Train the Trainers, because I believe if other people were to create similar incubators in their own local ecosystems, you would find traction and you would find people who want to do it. And of course, at the beginning, the people who are going to do it are going to have very strong opinions and very strong convictions in wanting to take that unusual step to be the role model. But the thing is, it's like crossing the chasm. It starts with the early adopters and those who really are willing to go out on a limb to do something really unusual. Then at a certain point, you start getting the other ones who are a little bit willing to do it, but not quite. Then you eventually get to this chasm where the mainstream is kind of on the other side. And once you get enough of these early adopters together, and then you leap across that chasm, and then the mainstream starts working with you, not because of their ideals, but just because you're good. And at that point, once you get the mainstream, eventually, decades later, probably the laggards, will probably come running afterwards from behind just because they don't want to be left behind. But that's kind of the way that you have to approach it. So we have to really start with the coalition of the willing and with those who are like-minded and who are willing to be the role model. And then once we exist, we are the case studies that the business schools will write about. And we will show that it is possible to operate things this way successfully. When I told people I wanted to start a nonprofit cybersecurity company, they thought I was crazy or they thought I was lying. But now, 9 years later, I can show them how much money we've donated to NLNet, and I can open our books and show it to them. And it's one thing to be like, you're full of crap before you've started. When it's still theory, it's a whole other thing once you've done it. And I've got 50 people that are earning their living. And I've got huge numbers of customers that are getting services from us on a daily basis. And that is what will quiet down the skeptics. And this is also the problem, I think, in general, with new economics, with things like post-growth, degrowth, donut economics. It needs to be more than just a macroeconomic theory. It needs to be more than just that concept. We need to take those frameworks, and they're beautiful frameworks. Asking the questions of, is growth good? And how do we build ecosystems that thrive rather than needing to grow? These are pertinent questions, but we need to take that and we need to translate these down one abstraction layer into the entrepreneurial level. And it is us as single individuals that will build it. And that is how it is. We then collectively, we form our economy. And then slowly from the bottom up, we can start getting more and more, market share, as you would call it, until we start becoming the mainstream. And that's the point where it starts becoming viable, because right now, most people don't even realize that there's a choice to be made. And there are people who would choose it. It's not the majority of people, but there are some people who would choose it. But the more role models and case studies there are, and the larger that movement becomes, the more people will start coming along, because it starts becoming perceived as normal, as a normal choice that you have to make. And that's how we're going to change things.
Excellent. So you've given us a very thorough, very expansive, and very enlightening, I'd say, a panoramic view of this whole concept of post-growth entrepreneurship. What I've taken away is it starts with a why, and it permeates every step of your journey, your business model, how you grow, at what pace you grow, why you grow, and where you grow. You've also laid out your funding choices as an entrepreneur, your different growth paths, whether it's bootstrapping or seeking funding from like-minded and congenial capital sources. We had a deep dive into what that means, also from a second-order perspective for the funding industry. All of this is just fantastic, right? So I feel pretty well-informed and well-equipped. So let's say Monday morning, I want to start on this journey. What are the top 5 actionable pieces of advice or guidance would you give to an entrepreneur who wants to take this path?
So the first thing that I would say that you need to do is educate yourself. I have been recording some videos. I taught a class at the University of Amsterdam called Post-Growth Entrepreneurship. I just finished up, I think, like 2 months ago, roughly. And I'm starting to put some of those videos on YouTube. Our company is called Nonprofit Ventures. So if you have a look there, you start seeing some. There's also a playlist. If anybody wants to reach out to me, I can also send you a link.
And we can put it on our website too. So feel free to share it with me as
Wonderful.
well.
Yeah. And anyone can connect with me on LinkedIn and I'll give you this information. But I would say it starts out with just watch those videos and inform yourself about exactly what post-growth entrepreneurship is. At that point, you'll kind of have at least the basic concepts. And then the next question is then you need to get started. And then it really starts with entrepreneurship. And it starts with making a decision that you actually want to take the first step, that you want to get started. And when you get started, you're not going to know what you're doing. The entrepreneurial journey is very much a creative journey. And it's not the kind of thing where you're just going to write out a 50-page business plan at the beginning and think you're going to get everything right. If you write that kind of a business plan, and if it turns out to be right, then you probably weren't being creative enough, And anyway, you would probably just got lucky. Because, most of the time the world is different and the market is different than you think it's going to be. That's the reason why with the lean startup, it's all about MVPs and pivoting. So, you really need to start on that kind of lean startup kind of journey. And the other thing that I would say is connect this really closely to yourself. And there's a particular practice that I would encourage that you won't be recommended from most business schools. But there's a really wonderful book, and it's called The Artist's Way by Julia Cameron.
I thought you were going to say that. I love it.
Yeah. And basically, the book is for what she calls, quote unquote, blocked creatives. So in other words, people who kind of fancy themselves to be some kind of creative or artist, or people who just kind of have some greater purpose that's within them, but it's just getting buried by day-to-day obligations and by our careers, our jobs, our just requirements and obligations. The whole idea is that there's 2 tools in this Artist Way toolkit. The first is called the morning pages, which is basically 3 pages of long handwriting every morning. And the second tool is something called an artist date, which is basically once a week you take yourself out for a date, which is just trying to give yourself the kind of creative input, just stuff for fun. It doesn't have to be useful. It doesn't even have to be educational. It's something you're curious about. And then what you'll discover is that entrepreneurship is a creative journey of synchronicities. And most of the innovations actually come from lateral thinking. They come from taking something from one area and then applying it to a completely different area. That happens to be where most innovation happens. But us rationalists and business people and techies, we're not so good at lateral thinking because we were taught how to be rational and how to think logically and just in straight lines. The great thing really is just that what these morning pages do every morning is they clear the rust out of your brain that's just gunking things up. And it just allows you to get some kind of creative flow that puts you in those spaces where that synchronicity will start to happen. And in business, your first customer is probably going to be your cousins, uncles, neighbors, dentists, who happen to tell about, but I know this person who has this company, That's how business happens. I mean, synchronicity in finding customers, synchronicity in meeting the right people, synchronicity in finding the partners that you want to work with. And that equals getting off the couch. But it also means that you need to also be constantly introspecting in the sense of like, how do I connect this to me as a human being? And that's why I also start with why. I mean, you do need to keep connecting it back to your why and making sure that it continues being connected to your why, because with entrepreneurship, it's hard. It's gonna fail sometimes. You're not gonna find traction. You're gonna fail at product market fit. You're gonna try and sell things and it's just not selling. No one's buying. You need conviction to continue on this path and to not just quit at the first sign of trouble. If you are doing something that is connected to you, you're gonna find that conviction to be able to stick it through. And to really be able to stay the course. Whereas if it's just some idea that you happen to get from some pitch competition where people gave you a few topics and you had to choose one, that's not going to be something that's super personal for you. And it's the same thing also with just choosing some topic because it's hot or because you think it's monetizable or whatever, or because you can have some passive income stream. Look, I'm not saying you can't be successful with these things. But if you look back, are you really going to be satisfied? It's not just about the result. It's about the process. You can have both.
Awesome. That rang very true. I can tell you personally. So thank you for that. I wrote morning pages for a very, very long time. I need to pick back up 5 years. I never missed a day. So thank you very much. Is there anything that you wish I had asked you, but I didn't?
I don't think so. You two also have a very interesting story, and I hope that you're also adequately sharing it, I'm sure. Also on your own.
Thank you.
Maybe the one thing is just more just like a question for you. I mean, if you were going to reflect on all of this that I just said, what do you think really just from your perspective, and what would you make out of all this?
To me, the single biggest takeaway, I mean, there are a lot, but if I had to just nail it down to one thing, it gave me an internally consistent route to entrepreneurship that sacrificed neither impact nor economics. And to me, that is the holy grail, because I have seen too many attempts or schools of thought or disciplines that go too far in the direction of impact, not to say that it's wrong, or that go too far in the direction of profit. So both of those resonate with me, and both of those kind of like the two scales of a balance, like the two parts of a balance. But I cannot fundamentally, being like a dyed-in-the-wool finance person, I'm not able to accept that you can just go for impact and economics be damned. That doesn't make any sense to me, because economics fundamentally is about the study of how you use scarce resources to meet unlimited needs and wants. So if you're not meeting those, it's like you cannot defy the law of gravity and you cannot defy the laws of economics either. So to me, the single biggest takeaway is that you can build an economically disciplined, scalable venture that respects what the market discipline forces on you, but at the same time pays equal importance to social impact and the larger impact. That growth in itself is not bad. It's the why and the how and the so what of growth that matters. So to me, that was the single biggest message and very encouraging message that I got from all of what you talked about.
Yeah, indeed. And definitely a mistake that I think a lot of impact-minded people really make is they think they have to do everything not for profit. And they think that they need to pay themselves below market. This isn't sustainable. I mean, you get what you pay for, and you also get how you treat people. If people can earn a better living elsewhere and they need that to support their families, they will do so. They will go somewhere else. Just because you're a non-extractive company, which basically is locking the assets in the company, it doesn't mean that you have to underpay. I mean, heck, it means actually sometimes you can even pay better because you don't have cash leaking out of the company. And if that cash isn't leaking out of the company towards the 1%, then it means you have more cash left over to reinvest, which includes paying your staff better. So we need to pay living wages, and we need to financially make those numbers meet, and we need to get the unit economics right, because if something financially doesn't stand on its own 2 feet, it's not sustainable.
I love it. And that is a perfect way, I think, to encapsulate everything you said. So I want to thank you again for taking your time. I know you're very busy, got a lot going on. I learned a ton. I'm sure others will too. And we wish you the best in everything you're doing. They're all very inspirational, noteworthy. So on that note, thank you so much, Melanie, for taking the time. We've had a great conversation. Thank you.
Thank you. And thanks for the invitation to come here.
My conversation with Melanie was one of the richest I've had on the topic of startup funding and the purpose of starting a new venture. It was provocative and insightful, packed with questions and what-ifs. Here are 3 highlights that stood out for me. First, the thought that Melanie put into creating the organizational structure of her startup was deep and very impressive. As founders, we tend to take some foundational assumptions about startup structure as given, but there are other, better options. Have we looked deeply enough? Second, Melanie gave the most incisive and crystal clear overview of the venture capital model that I've heard to date. Few founders realize that the government is the world's largest and, frankly, the most founder-friendly VC fund, or that the gains enjoyed by private VC firms are made possible by the government's giveaways. That VC funding can result in really unfavorable outcomes for both startups and their founders by the nature of the VC model itself. Keep this in mind as you define your capital stack. Last but not least, I loved Melanie's clear explanation of multiple funding options for founders who want to bypass venture capital completely. She did a great job laying out the trade-offs involved in a way that makes it much easier for you as the founder to craft the funding and growth path that fits your ambition and your mission. So, what's the biggest mission for your startup? And how can you craft the structure in a way that makes you profitable and fit for your mission? Thanks for listening to today's episode. We have show notes and more at achieve.co. That's achieve.co/podcast. Like what you heard? Hit subscribe and share with a friend. See you on the next episode. Now, go be an achiever.